Hello, everyone. Good morning or good afternoon, depending on where you're joining us from. I'm Olga Makarova, Marketing Manager here at COFAS, and I'll be guiding you through today's session. Thank you all for taking the time to join us. Today, we will dive into Urba360's score and how it can help you make better business decisions. Our expert speakers, Andrew Scher, Group Solutions Engineer Director, and Matteo Gatti, Head of Data Strategy, will guide us through the nuances of the score and how you can apply it in your business. A few quick housekeeping notes. The webinar, the presentation, and the demo will run for around 30 minutes, followed by questions and answer session. So if you have any questions during the webinar, please feel free to drop them in the chat or the questions tab that you can see in your navigation bar on the right, and we will answer them live afterwards. But before we begin, I'd love to get a sense of where everyone stands with Urba. So let's start with a quick poll to gauge your familiarity with the tool. You will see a pop-up just now. Yes, thank you so much for your participation. Let's wait a couple of seconds. Okay, I see questions, answers coming in. Thank you so much. I see that most of you, around 73%, haven't used Urba yet. Okay, well, hopefully after this session, you will have your questions answered about this tool. And those of you who are familiar with it will know how to use it better. We will send a couple of more polls throughout the webinar to make the session more interactive. So thank you for your engagement. And with that, Andrew, the floor is yours.
Thank you very much, Olga, and hello to everybody. Hope you're well on this fine Thursday. Okay, so first of all, just to give you a little bit of background on COFAS for those of you who perhaps are not engaged with us currently or are obviously established clients. COFAS, we're a global leader in trade credit insurance and business information. So we have heritage that goes back, almost 80 years now. And as a global trade credit insurer, we are covering almost 700 billion of trade across the world, and we operate and cover transactions in over 200 territories worldwide, where we have significant financial strength as recorded by the main rating agencies, and we deploy a global team at local expertise. And what I mean by that is that we have people on the ground covering those 200 territories from around about 67 physical offices, but we work with global partners as well in order to provide our solutions to our clients. We also have trusted partnerships with our clients. So we have over 50,000 clients who rely on COFAS's recognized services to navigate the complexities of global markets. And particularly with a global trade credit insurer, you need three distinct pillars in order to operate globally. The first pillar being information consumption, a team of risk analysts who are able to work with our information partners, enhance the information that we observe. We take a lot of signal information, and we'll do a deeper dive on that throughout the presentation this morning, and ultimately you get an understanding of how ultimately we work. In that first pillar, the outcome essentially is our score, and the score is what sort of steers the overall risk business within COFAS. The second pillar is that of underwriting. So we have underwriters, again, local to where the risk is, so they understand what's happening in the local economy, what's on the ground, and are able to react very quickly towards a very changing environment. And of course, at this moment, we are in a particularly changing environment. And then the third distinct pillar of a global trade credit insurer is debt collection and debt recovery. So we have a claims and debt recovery pillar, which also is operating close to the risk in those countries and territories, so that we're able to then demonstrate recoveries of delinquent accounts, should they happen. So as a global trade credit insurer, that is pretty much the breadth of how we operate from a high level. So just staying topical, and of course, risk is our business, and we are now perceiving obviously a lot more risk. We've enjoyed a time of low interest rates since the financial crisis, but of course, as industry, countries were normalizing over time and over the past decade. We sort of enjoyed those low interest rates, and economies were largely growing across the world. Then, of course, we have the pandemic, which really put a pause on growth, and really, no one pretty much knew what was going to happen from that. But of course, governments intervened. The insolvencies, particularly, were not as great as were first forecasted. But since we've come out of the pandemic and we've come to what we class as some kind of normalization, if there is such a thing in this current climate, we're actually now seeing and observing insolvencies on the increase. So, we've gone past what were reasonable times. We've gone through the pandemic, which was a very challenging time, but now we are seeing risk more prevalent in all markets and major economies particularly. And this is just an overview that you can see that's happening. So you'll see on the left hand side France, Germany, Italy and Netherlands, and you can see the overall scale there, and then obviously US, UK, Japan and Brazil on the right hand side. So we've gone past what was the pre-pandemic 2019 levels, where we would class that as perhaps a normal sort of benchmark year, but now we are seeing significant increases on the rise with insolvencies, and we only have to look at what's happening around the world to understand why that is. So just on this, after this slide, we'll just pause for a moment for our second poll. So Olga.
Yes, we see answers coming in. And about half of our viewers are monitoring their business partners and suppliers periodically. And around 17% of our audience don't do the monitoring, just doing the onboarding.
Good. Thank you, Olga. Okay, so we have sort of a mixed audience in respect of experience and what is being deployed. Okay, so we'll move to the next slide. So obviously we're talking about COFAS's score and how our probability of default score can ultimately help your business and help you to monitor the suppliers in your primary supply chain. Here we're just sort of observing, where can disruption come from? It can come from out of the blue. As I mentioned sort of early on, the world has sort of enjoyed this level of cheap access to funds, and that has meant that over time a number of businesses have been able to survive, sometimes thrive, because of that cheap access to funding. Now, since interest rates have gone up, yes, they may be starting to come down in some economies, but they're not going to get back to those levels that we enjoyed pre-pandemic. So ultimately, there is a lot more risk. That's what's driving up the insolvencies, as commodities pricing, doing business is getting more expensive, and access to funds is getting far more expensive as well, because companies are now renegotiating those long-term debts that they may have enjoyed at cheaper interest rates. They're now paying probably double, if not triple, if not more than that in some instances. That really does squeeze these companies to the point that they may not be able to pass on that to the consumer, their customer, and ultimately that's where the criticality of stress will come from. Now, if we look at disruption in supply chains, we think typically of major events. So whether it's the invasion of Ukraine, whether it's the Evergrande being stuck in the Suez Canal, or whether it is, adverse weather event, these are the kind of things that typically we think of supply chain disruption. But in actual fact, the main cause of supply chain disruption is business failure, and it is the insolvency of a company in the supply chain. And it may not be a company that's in your primary supply chain. It could be a major supplier in that supply chain upstream, which could be your tier two suppliers, those who are supplying into your primary suppliers, or tier three, or beyond that. It really depends on the criticality of the goods or services being provided, within that upstream tier. So what we represent here is, see some pretty little pictures here. Imagine that you are at the center of this, this circle, and you deploy a radar, and your radar essentially is how you are monitoring your primary suppliers, and then potentially you may know who some of those secondary and tertiary suppliers are. Now what can actually happen is you'll see it's sort of a little graph with a jagged arrow declining. That's the sort of insolvency prediction observed in your tier one, tier two, or tier three suppliers. And that's where COFAS is identifying companies within your supply chain that are very weak. And what we class from a probability of default perspective as high risk. And then you will see on the top right hand corner an asteroid. That ultimately is something that can come out of the blue and could be knocking into the tier three supplier, tier two supplier, and really impact your tier one supplier and your business. So monitoring your suppliers, not just at the point of onboarding, but also at the, through the life cycle of that supply, can be critical, because disruption, as I say, can come from the impact of an insolvency. And if you think of your business needs to operate very similar to an aeroplane. It needs to be flying in the air as long as possible, but insolvencies and any kind of impact can really ground that plane on the ground, and then ultimately that's not what your business needs, because impacts to your supply chain, you may have put advance payments, deposits, you may have to find more expensive alternative suppliers. If you don't have the time to react, then of course that can really impact your business quite severely. And we have seen, and we do observe in COFAS, the effects of that. And that is sort of the impact of insolvency. Now typically our score, built as probability of default, gives you that early warning. So by monitoring your buyers, essentially we're designed to give as an early warning of as possible of to what weakness is to come, and then from that it gives you time to react. That reaction could be that you're looking for alternative suppliers, or that you're thinking of different terms in order to manage that supplier in itself. And they may be a critical supplier, so there's perhaps something more strategic that you need to deploy at that point in time. So here we're just giving you, a very kind of quick overview as to what COFAS sees.
Yeah.
By the way, we'll be leaving questions and answers to the end, so hopefully you'll have some questions later for us on that. And I hand over to Matteo.
Yeah. What is basically a supply chain? A supply chain is just an interconnection of dots that are the companies and arches that connected this company. And when it comes to measuring the risk, this is exactly what COFAS does every day. We have a good assessment of the risk of each dot. We can decide how a company is risky, is at risk. But moreover, we can weight the level of risk within the connection, because the company is not a standalone business, but as a lot of connections that come from this company or to this company, and the way these connection change is a good, I would say, early warning or proxy of how this company is going to increase in risk. And this is what we are experiencing every day. First of all, is that when it comes to connection within the same sector, every company thinks that they know perfectly their own sector, but this is not true. What we measure here is the level of claims split by sector, and as you see, many of those are from the same sectors. The second point is that when it comes to measuring the dynamics of the sectors, there are sectors that are more exposed to systemic risk, and and what happens is that single companies, if you look at the single company at your supplier, it may not be at risk, but what you see is that all the connection from and into this supplier are becoming weak, are causing, are deflating. So this is a signal that you need to manage and monitor. Basically, when it comes to measure the risk today, we need to focus moreover on weak signals rather than hard signals. Because after the pandemics, all hard signals have been, I would say, diluted over time, but weak signals became stronger. And of course, as Andrew shared, we manage around the 700 billion exposure. We are able to determine the risk of a sector, also for companies that have no insurance with us, because we see a lot of transactions within the sector. We see the dynamics. We see that we have super nodes that became at risk. So mainly, what is key is to have in mind that you don't even know the companies within your sector, and the dynamics within a supply chain are not only related to to your business, but with all the interaction that this company is having with the full ecosystem. And we are experiencing it every day by measuring, claims from unpredictable sectors to other unpredictable sectors. And here we have a poll for you again, Olga, if you want. We charted the key, the tools used to manage and measure the risk of your business partners.
We'll wait for a couple of seconds for the answers to come in. Thank you all for your engagement in this. Okay, we can see that half of our audience is using third-party credit reports. Around 40% conduct in-house financial reviews, and a bit less than 10% don't do any sort of assessments.
Yeah, this is an interesting point to me. The financial review done in-house are a used tool, of course. I see that a lot of people is using it. And well, I would have a question for you, but because it affects our job, how do you manage complex countries where having financial information is much complicated? This is, I would say, this is how global supply chain are impacting. The traditional financial review are becoming more complex. And so I'm sure that is a challenge for you as for us. And to enrich the way we help our customer in evaluate companies, we are offering a 360 business overview of a company. These are basically all the levers that us as insurers use to evaluate a counterpart risk. And this is exactly what we provide to our customers within the platform Urba. First of all, I would say we have our score that is a 0 to 10 score, and it's targeted to represent the company probability of default over the next 12 months. What is key is that this definition of score is global consistent, and the PD definition is the same. So whether you are evaluating a company in the UK rather than in Italy, the score 3 will have the same meaning. So you have a consistent view of the risk all over the supply chain, even if this is global. Then, of course, we provide a credit limit recommendation based on our experience up to $1 million or euros. Of course, we support you in analyzing the financial health, using the ratios, the financials, and also giving a kind of sectorial placement of each indicator. And we provide this analysis in also in this case global consistently. So doing also the financial assessment may be easier because you have the same structure across the globe. Of course, as an insurer, we track and we obtain information on the payment behavior based on this 700 billion exposure we have. So it's true, it's real world experiences, it's real world evaluation. Of course, we have economists that measure, analyze, and provide updates on the economical and political stability of the country and of the sector. We have two levels of, I would say, data collection in this case. One is the global, the macroeconomic scenario that is developed by a team of economic analysts. And one is a country level assessment of the risk that every day we have more than 300 people in the world that do assessment of the risk of the sectors, of the companies at local level. So there is this continuous interaction because global economies may see the macro trends, but the local sectors can see the micro trends. And so this is what we are offering to every customer to support them in their day-to-day activity. And we are sharing our expertise because these are the same levers we are using as in our day-to-day job. We are not a usual business information company because with our second soul as an insurer, we have a difference. When we do wrong evaluation, we pay. So we are used to, we are in the same shoes of our customers for some aspects. And well, just the last overview on the process that every single data point will run through. We rely on a lot of public and open sources, public data providers and whatever, meaning that we want to have access to the best data we can in every country. If in the single country we don't feel there is the perfect provider for us, we will create the information ourselves with production centers. From these, I would say, a common layer of data, we start developing raw scores, we consolidate the data, and so we have, I would say, a self-produced, a self-aggregated information report that is the starting point for all the value-added activities we do on this data. First of all, we append an easy number, meaning that we give to every company in the world, in our database, a unique identificator that it's, I would say, unique, that it's global, that is consistent within the globe. Then we do some specific data enrichment activities using our analyst team, using data we collect from the transaction, from the payment, from the sectorial risk and whatever. And then we go up to a final score, that is the DRA, that is our score. That is the result of a full, I would say, a full qualification process that you see, and we're happy to share with all our customers. So basically, we move from, I would say, billions of data points to a single score that is at the heart of our decision, of our job as insurers. So I would leave the floor back to Andrew for the last slide.
Thank you, Matteo. Okay, so factors sort of influencing the score, as Matteo said, our scale is 0 to 10 and is deployed globally and is globally consistent. Now, just to give you a sort of a deeper dive into some of the information that is surfaced, or what are we doing behind, we're taking information from our information partners, both on industry, number of employees, legal structure, etc., everything that you would typically expect us to see. But of course, we're examining the trend analyses as well, not just of the financial indicators, but also of our own score. So we're looking at the trajectory of the score that we've produced from all of the information. And again, we have risk analysts who are also sort of working behind the scenes in the local countries, observing and reevaluating the risks. And we're quite privileged in our position as a trade credit insurer, in that a lot of companies are providing us with additional insight onto their business, which could be management information, management accounts. We also take into account when a business is part of a group. So the parent company could have an influence on the score that we produce. So, we're looking at it from a very, we talk about 360 all the time. It's a very holistic view in respect to the subsidiary business or the mother company. How important is it? Is it a fully integrated subsidiary, i.e. it does exactly what the mother company does, but maybe in a different location? Or is it part of an investment? These are the kind of drivers that we need to understand as analysts, because as Matteo said, we are writing a risk somewhere on this business for one of our clients. So as again, we have over 50,000 clients in our trade credit insurance business, and so their needs are driving where we are focusing our risk analysts and risk underwriters. So the key information for us is to gather whatever is available publicly, but then to sort of layer that on top, which is obviously what Matteo was just sharing with you. So this is just another sort of deeper view, but we need to be confident about those next 12 months horizon, and that's how we underwrite risk particularly. Now we'll move to, before I sort of move to sort of demonstrate how you can observe, the solution from COFAS, particularly focused on the score. We'll just run a very quick poll, which is if your supplier score drops from mid-risk to high risk, what do you do?
Let's give it a few more seconds before we get more responses. Appreciate all of your engagement. Okay, seems like 48% of our viewers would implement prepayment safeguards, for example, prepayment. Around 30% would request a risk mitigation plan, and 20% of our viewers would source alternative suppliers if the score drops.
Great, thank you, Olga. Very interesting. So again, we still have sort of varied experience. Okay, so I will now share with you a couple of examples that we've sort of put together, just so you can sort of optically see how we provide our solution from COFAS from a business information perspective. So bear with me while I hopefully you can see my screen. Olga, can you see my screen?
Yet.
Is it coming through?
No.
Okay, bear with me. Let me try that again. Apologies for my lack of technical competence. Now, can you see my screen?
Yes.
Okay, good. Okay, so essentially, we have a product called Urba360, and it's the principal solution from COFAS. Essentially, Urba360 is the greatest partnership between the information that we source and the information coming from the risk activity within COFAS. So we produce a dashboard ultimately, and here this is a view of the dashboard that would be seen in our Urba360 platform. We produce a very quick overview, and it's in the color scheme of a traffic light. So if it's green, it's good. If it's amber, there's a warning, and if it's red, it means that there's something negative to observe. So we look at the main components, and the dashboard is given so that you can very quickly visualize, is this a good company, bad, or is there something challenging that we need to look at? And within this wheel, as we call it, on the left-hand side, you can deep dive into each major component. Here we've been talking about the score, and particularly when we drill down into each component of that wheel and to each section, you can see what the score actually is here on the left-hand side, what our credit opinion and recommendation would be of this business. If financials have been able to be surfaced because they're publicly available in the country, we can also provide that information in the financial, and we build financial ratios based on that. The late payment information. So in this particular case, it's ticked as green. So we have observed no negative payment information. Just as a reminder, as Matteo said, this information can be coming from what COFAS physically observes. So this is real cross-border trade, and this is why particularly it's important, because cross-border trade, significant amounts from one counterparty to another, that COFAS would be underwriting that transaction. Our credit insured clients are notifying us of what they observe, and as soon as they would surface any challenging or particular default and non-payment, that is coming into COFAS's engine. So ultimately we're observing that, and that can have a key impact on how we assess that risk going forward. So it's a really good insight in order to share it. Matteo, of course, mentioned also the country risk assessment, and of course we have the sector risk assessment as well. And in each one of those views, we can see the history as well. So in each and every aspect, you'll be able to see the evolution of those, because trend and the trajectory of scores is also highly important, because you've got to think about, and we think about, the next 12 months of trading, and ultimately, how safe will that be? So just going back to the score itself, as we mentioned, as Matteo mentioned, we work on a scale of 0 to 10. 0 being default, 1, the company is very high risk, so we class that as the company's pretty much on life support, and up to 10, whereby obviously it's low risk. But you can click into each field and the score itself, and you'll be able to observe the probability default set at each level of our score, and then also the score history itself. So here, over time, you can observe how COFAS has scored this particular business. Obviously, we've anonymized these companies, because this is actually based on a very live business at a point in time. And this is a very stable, low risk concern, and a risk that COFAS is currently monitoring for credit exposure. Now, of course, when we look at companies, we'll have a varied mix of industries and sectors, and of course, a varied mix of results in respect to scores. So I can very quickly share with you a score on a business which doesn't look so good. In actual fact, this particular company, it is a real business. It was a manufacturer of motorcycles, showed significant stress and actual failure quite recently. And our score obviously is 0 because it has entered a form of insolvency. We don't, of course, recommend any credit. There were financials available, but COFAS also had observed information and negative experience in late payment as well. So we think about the network of clients who we serve, and they are providing us with indications of payment slowing down, non-payment, and that really starts to build a picture for us. So that was one of many signals that COFAS ultimately observed on that particular business. So we were able to see and react at a point in time much earlier than the particular failure itself. If we go to the score, it was a very well financially sound business to a point in time, but ultimately, you know, in the last sort of 12 months or maybe 18 months, it became a risk that was quite highly and sensitively managed by the risk team in COFAS, and ultimately, you know, we were guiding our clients out of this risk as best as possible. And for us as a trade credit insurance business, it's part of our job to steer and manage risk. And that means that the job of a risk analyst and risk underwriter in COFAS is that we're using the score to prompt us to ultimately decide what are the next steps. Ultimately, as a trade credit insurer, we are trying to, if we do see those warning signs of, you know, there is a demise on the horizon, then ultimately, you know, whether that's the payment default or whether that is the actual insolvency, you know, we need to build a strategy towards navigating our clients out of that risk safely, not to precipitate failure, but ultimately to extract from that risk without preventing failure, but also by our clients, you know, coming out of that risk without any contagion financially. And so, you know, we were able to observe, you know, this risk, monitor it, see that it was declining, and build strategies. And then, if you think about yourselves as suppliers, you can use the same methodology and use the score as that warning signal, or i.e., it could be a signal that is in improving position, which means, oh, I could buy more. Or, you know, it can be that where we're showing the weak signals, it's an idea to think, well, what is my strategy going forward? Do I need to find an alternative supplier? Do I need to work with this business a little bit more closely to understand, you know, what ultimately is happening behind the scenes? Really, the score is acting as a very good monitoring mechanism that you can deploy in your business to help you, you know, trade safely, both from a credit risk perspective, but also in monitoring your supply chain.
Thank you very much, Andrew, Matteo, for this walkthrough. And now it's time for our questions and answer session. Everyone, please feel free to drop your questions in the chat or in the questions tab. And we have a couple of questions already sent to us. Andrew, Matteo, if you can have a look.
Hi, Matteo. I think you're on mute.
Yeah, now it's better, probably. The first question I have in the question tab is how do you define default partner? For us, the default definition is a kind of combined default. So basically, we have official default plus, I would say, big default in payments. So it's a combined default from official default and obligation not met at high extent. Then I will leave the floor to Andrew for another answer if you want. If not.
Yes, sure. So we have a question in respect to where does our payment info come from? Actually, the payment information comes, largely from the base of our customers. So as I say, we have 50,000 trade credit insurance customers worldwide. And because we're underwriting those transactions on their behalf, they are contractually obligated to notify us of any observance of adverse payments. So that is coming into COFA. So we can be talking about hundreds of thousands of payment information performance data. And of course, where we don't get any signals of adverse information, that means that actually it's a good signal in itself, as the payments that we're underwriting, the exposures that we're underwriting. And again, I remind that this is cross-border. It's typically we're not talking small amounts here. We're talking typically scales of a few thousand euros to hundreds of thousands, if not millions of euros at any one point in time. So if you think of that almost 700 billion of risk that COFAS has, we're underwriting that. So we're observing some 30 million companies at any one point in time underneath all of those transactions. And that's the power of the insight that comes from COFAS.
Then I see.
There's
But please, Andrew. No, please.
Yeah, there's another question in respect to, is the information available as an API for tech partners? We do have a partnership program, and we do deliver our information via API. So certainly it's a discussion that we can have. So you can contact myself or Matteo, and certainly we could have a conversation.
Yeah. We have a lot of data partners from which we retrieve information on, and we manage to have multi sources behind the score. So this is the situation. So a lot of sources depending on the country, a lot of providers behind those specific data providers, and I would say multi-sourcing approach for each and every country. Then I see a question about the credit score is the same as we see on the icon reports. The DRA, no, is not the same. This reflects the insurance expertise we have. So it's icon shows more the commercial risk. Here we have a more holistic view of the risk that is measured in DRA.
And we have a question in respect to how would you assess a company belonging to a group where the entity you are analysing is treated as a cost centre, so low profit, but the group parent is very financially healthy? Well, it's exactly why COFAS takes the strength of the parent into account in many instances of our score, because ultimately the desire of COFAS, that the principle is that we want to underwrite and support trade. So it's very common that we find large groups with subsidiaries that are treated as cost centers. So it's for our risk analysts to understand, the actual hierarchy within a group and understand the dynamics. So as I said before, is it an integrated business? Is it just an investment? And those are the criticalities and dynamics that drive that. And that's why we deploy almost 1,000 risk analysts and risk underwriters across the world, because they need to nuance that. Because if you were just algorithmically doing it on standalone basis, then most typically you would see the subsidiary in a very poor light, and ultimately we wouldn't be able to give a good score, and we wouldn't be writing an opinion. But we have many examples whereby, yes, we understand how the business works, and as part of trade credit insurance, it's our job to understand that, to underpin the trade. So from that, we get that that comfort, and we will provide the score, largely representing that understanding. And again, it's one of the unique qualities of COFAS.
Are there any chances that there are no rating score given? Yes, there are, but remember that is not in our interest. Our main interest is to find a way to assess the risk of the company, because our job is to assess properly the risk, because if we assess the risk of the company, it means that we can give them an exposure, and so we can do our job as insurers. In sometimes this is where, again, we are in the same shoes of our customers, because we don't want, of course, to take too many risks, but we want to take risk because it's part of our job, and we are paid as an insurance for the risk we get. So yes, in theory, there are any chance to not to have the score, but I can say that it is in our interest to keep this percentage as much as low as we can, because every time we cannot assess a risk, it means that we cannot take an exposure on this, and so we cannot be paid. We cannot be paid for it, as well as our customers, let's say.
Thanks, Matteo. We have another question, which is, where can we find some material that could help us read the financial report so we could interpret correctly these reports? So it's a good question. So what we've done with Urba360 is that the financials that we actually deploy into the dashboard ultimately are based on a global IFRS standard. So reading financial information, we make it, I guess, easier to compare one set of financials with another on a global basis. So as we mentioned, our score is read consistently as a POD across the world, and the financial data that we re-represent within Urba are also on a global standard. So ultimately, in reading the financials themselves, we've made it easier to understand that. So hopefully that answers your question. So at least you're looking at our information, the financial ratios, and also the financial information itself. And there are some key leading indicators on the financial ratios to interpret, built into the dashboard itself.
Well, I will try to answer in a generic way to many questions that are coming in. It's do you use this information in the report to assess the risk? If some company asks for a bankruptcy, do you manage it, and so on? Generally speaking, what I would say is that every information, and these questions are specific to a single country, because some events can occur in some countries and not in others. Generally speaking, everything that is going to impact the risk of the company is taken into consideration and is assessed within our score. So meaning that if we get some notice, some information that to some extent can bring to a review of the score, lowering it or raising it, we will keep it in consideration. Because as I said you 2 minutes before, our interest is to have the most realistic view of the risk of this company. So generally speaking, is yes, we want to be as close as the market as we can. This is why, for example, we recently bought a company in the GCC region that is Cedar Rose. This is the participation in this company, and so on, because we want to be close as much as we can to the market, to the data sources, because we want to have the maximum speed in retrieving signals that can, impact the risk evaluation of the company. So generally speaking, yes, every signal on the market for us is good to be taken into consideration and weighted in the score.
Thank you so much, Matteo and Andrew. That's all the time we have for today's webinar. Thank you all for joining us, and huge thanks to our hosts. If you have any further questions or you want to delve deeper into Urba360 and how it can work for your business, please don't hesitate to reach out. We'll be sharing the recording of this webinar as well. Have a great day and hope to see you again during our next webinars. Have a great day, everyone.
Thank
Bye.
you.
Thank you, everyone.